What is amortization? So, amortization, put very simply, is paying off a debt over time in equal installments. So, all it really means is that when someone takes out a mortgage loan, most people are usually looking for a fixed payment. So, they get a fixed rate mortgage, right? You want to know what your payment is month to month so you can budget appropriately. But with the interest being charged and the loan balance that we want to pay down, we have to do what's called or we have to set up what's called an amortization table so we can have the same payment, but our principal and interest portions will actually be changing every single month. So, for example, here, I'm going to show you this example in this scenario analysis. We're looking at a $600,000 purchase price with a $480,000 loan amount, just a typical 20% down scenario. Our rate here is 6.625%. And again, this is just for a hypothetical situation. And our payment is 38.23 and 49 cents. But what we're really focused on here is the principal and interest portion, which is right here, $3,073.49. That will be fixed for the life of your loan. But like I mentioned, the principal and interest portions will change every single month. So what do I mean by that? Well, if I show you an example here, this is what we can look at to see the trends of how things are changing. This is what's called an amortization table or an amortization schedule. And again, same loan scenario that we just explained with 360 payments. Just to break down what we're looking at here, you probably won't see this too often, but here on the left, we're just showing the payment number. We'll have 360 of those and the payment dates. So that's showing you first date of every month that you're making a payment. This column is a beginning balance, and I added an orange gradient data trend to this so you can see at your loan balance being paid down. It's going to be the same here in beginning balance and ending balance. Those numbers are slightly different, but the point is you're paying down that loan balance from 480,000 to zero. So you'll see the orange disappear. And then we have the scheduled and total payments here. Same thing, $3,073.49. And I'm showing here the principal and interest side by side. So what you'll find is that in each respective column, the principal and interest added up is going to equal to $3,073.49. But as I scroll through the loan, you'll see that more and more of that portion of the payment is going towards principal and less will be going towards interest. So as I scroll down to the life of the loan, you'll see the green increase and the red decrease. And in this last column, I'm also just tracking the cumulative interest. So it's just adding up all the interest payments that you've been making, and you'll see the red increase, so you know that the cumulative interest is being added on. So the main thing I want to focus on here, again, principal payments increasing and interest payments decreasing. So I'm going to scroll through. This is us going through the life of the loan. We're already seeing this go up. We started in the 500s for the principal section. Now we're at the 900s, and interest was like at 25 or 2600, and that's going down. And same thing again. Green is going up, red is going down, and all the way to we get towards the end here. So now it's completely flip-flopped, which just shows the inverse relationship that they have through the life of the loan. So what does that mean for you? In order to pay down your equity as fast as possible, just based on your fixed payments, you want to get to the latter half of your loan term. To further illustrate this, I have some graphs here that just show principal payment portion versus the interest payment. The green is the principal payment, so it starts off smaller and increases as the life of the loan goes on. Yellow is interest, and so it starts off higher like we showed in the other graph, and it goes down. And then again, well, to mention, following that inverse relationship. And then I'm showing you the balance of your loan paid down versus the total interest paid. So yellow here is that interest being paid. This is a cumulative interest all added up, and your loan balance going down. That's starting at 480 over here on the left and going to zero. So there's an inverse relationship going on specifically in the principal and interest portions to get you that fixed payment. So hopefully that all makes sense. If there was anything you may have a question on or any scenarios that you want to see, please, of course, comment, message me, or let me know in some fashion, and I'd be more than happy to help out with that. And as always, please like and subscribe. as it helps me out. And if you have any more ideas of anything else that you want to see explained, please let me know, of course. All right. Thank you, everyone, and have a great night.